Hook the mystery. What if financial collapses aren't accidents? What if they're not failures of forecasting, regulation, or intelligence? What if collapse is expected, just carefully delayed? Every major crisis comes with the same promise. This time we fixed it. New rules, new safeguards, new institutions. Yet, somehow debt grows larger, bubbles inflate faster, and collapses return with even greater force. So here's the mystery we're unpacking today. If governments, central banks, and economists know how crises happen, why do they keep happening anyway? The uncomfortable answer is this. Modern financial systems aren't designed to prevent collapse. They're designed to postpone it long enough to extract maximum value before the reset. And once you see the pattern, you can't unsee it. Setting the stage, how collapse became a feature. To understand why collapse is delayed by design, we need to step back, far back before bailouts, before central banks, before modern money itself. For most of human history, money had limits. Gold had to be mined, silver had to be minted. Credit was personal and risky. When a kingdom overspent, collapse came quickly. Wars ended empires. Bad debts triggered revolutions. There was pain but also reset. The problem for those in power wasn't collapse itself. It was losing control during collapse. And that's where the design began to change. Origins, the birth of managed failure. The turning point came with central banking. The Bank of England in 1694. The Federal Reserve in 1913. The idea was sold as stability lenders of last resort, controllers of panic, guardians of the currency. But behind the promise was a deeper shift. For the first time, governments could borrow without immediate consequences. Money could be created to cover debts. Interest could be paid with newly issued currency. Collapse didn't disappear, it just slowed down. This was the birth of managed failure, a system where problems were deferred instead of resolved. Every crisis became an opportunity to extend the timeline. The rise debt replaces discipline. As the 20th century progressed, the system learned a powerful lesson. Debt works best when it never gets paid back. After World War II, governments realized they could grow economies not by producing more, but by borrowing more. Debt-funded growth looked miraculous. More spending, more consumption, higher asset prices, political stability. But this growth wasn't organic. It was synthetic, powered by expanding credit. Then came the final unlock. In 1971, the US severed the last tie between money and gold. Money no longer represented stored value. It represented confidence, and confidence could be managed. From that moment on, collapse became optional as long as belief held. The mechanism how collapse is delayed. Here's how the delay actually works. When debt grows too large and systems strain, central banks intervene, lower interest rates, inject liquidity. By failing assets, guarantee losses. This doesn't fix the problem, it moves it forward in time. Low rates encourage more borrowing. Bailouts reward risk-taking. Asset prices rise, making collapse politically unthinkable. The system becomes addicted to intervention. Every delay makes the eventual correction larger but also more distant. And distance creates denial. The breaking point. When delay replaces reality, eventually reality pushes back. The 1929 crash exposed leverage built on speculation. The response, monetary easing. The 1970s inflation crisis exposed currency dilution. The response, temporary tightening, then more borrowing. The 2008 financial crisis exposed systemic fraud and excessive leverage. The response, trillions created overnight. Crisis was framed as unexpected. Each solution involved more debt. But notice what never happens. Debt is never meaningfully reduced. Losses are never fully realized. The system never resets. Collapse is postponed and prevented. Fallout: who pays for the delay? Delaying collapse isn't free. The cost is hidden in places people don't immediately see. Purchasing power erosion, asset inflation, stagnation, wealth concentration. When central banks print to stabilize markets, asset owners benefit first. Stocks rise, real estate inflates, debt becomes cheaper. Those without assets fall behind. Collapse is delayed by spreading its damage over time, quietly, unevenly, politically safely. Instead of a sudden crash, society absorbs a slow bleed. Failed fixes, why reforms never work. Thrive. After every crisis, reforms are announced. New regulations, stress tests, transparency promises. But these fixes share one flaw. They never challenge the core engine debt-based growth. Because stopping collapse would require allowing defaults, accepting short-term pain, reducing leverage, shrinking financial power, and that's politically impossible. So the system chooses delay, not because leaders are evil, but because collapse within their term is unacceptable. Modern parallels, the pattern repeats. Look at today. Global debt is over 3 times global GDP. Interest rates rise and instantly threaten collapse, so rates can't rise too much. Inflation appears and central banks claim it's temporary. Markets wobble and liquidity returns. Every signal points to instability. Every response pushes it further down the road. This isn't mismanagement, it's consistency. The shocking truth: collapse needs timing. Here's the truth. Few will say openly, collapse is inevitable in debt-based systems. But when it happens matters more than if. Delaying collapse allows assets to be extracted, positions to be secured, power to consolidate, narratives to be prepared. The longer it's delayed, the more controlled the outcome can be. Chaos is the enemy, not collapse itself. 3 key takeaways. First, financial systems don't fail suddenly, they weaken gradually. By the time collapse is visible, the decisions were made years earlier. Second, stability is often artificial. When markets feel calm despite rising debt, intervention is usually the reason. Third, delay benefits insiders. The longer collapse is postponed, the more uneven the damage becomes. Warning: the open question, the real question, isn't whether collapse will happen, it's whether the next one will be sudden or slow, visible or silent, chaotic or managed, and whether ordinary people will recognize it while it's happening, or only after. Because delayed collapse doesn't look like disaster. It looks like normal life getting harder. Call to action: if this changed how you see financial stability, if you want deeper breakdowns of money, debt, and hidden systems of control, subscribe to the channel. Because the most dangerous collapses are the ones designed to feel like nothing is wrong.